company lost its crown jewel memory chip business. How did this happen? Toshiba was a trusted Japanese industrial giant. It made radios, semiconductors, and heavy machinery. In 2006, Toshiba bought Westinghouse, a U.S. nuclear contractor. On paper, the move looked strategic, a global brand, a new entry into big-ticket energy. Management said nuclear would anchor long-term revenue. The risky decision arrived quietly and then all at once. Toshiba embraced Westinghouse's promise to deliver next-generation reactors on fixed prices and tight schedules. Those contracts put Westinghouse on the hook. When Toshiba became the owner, those contractual commitments became Toshiba's commitments. The company took on legal and financial exposure that could not be shrugged off if projects went wrong. Momentum followed. Toshiba won large reactor contracts and publicly signaled global ambition. Shares rallied on the promise of future earnings from nuclear power. Banks and investors provided credit. Executives touted the strategy. Recruitment and hiring accelerated. For a time, the gamble looked like a masterstroke. Warning signs emerged. Construction sites reported delays. New U.S. regulatory hurdles added months to schedules. AP1000 reactors revealed engineering complexities that designers had not fully priced into the contracts. Early cost overruns that would normally be contained began to creep upward. Project managers and site engineers raised practical concerns about schedules and materials. Those concerns translated into creeping expense estimates on corporate spreadsheets. The losses escalated in stages. At first, the overruns were tens of millions. Short-term profits dipped. Managers adjusted forecasts and put staff on overtime. Then engineering setbacks and contractor disputes multiplied costs into the hundreds of millions. Cash buffers shrank. Credit costs rose. Suppliers tightened terms. Mid-level managers faced impossible deadlines and cost targets. The situation became critical when Westinghouse itself reported severe problems on multiple U.S. reactor builds. Estimates for completion and penalties diverged from original plans. Toshiba's exposure ballooned. The company recorded multi-billion-dollar write-downs tied to the nuclear projects. Investor confidence collapsed. Credit ratings fell. Share prices plunged. Employee pensions and regional economies that depended on Toshiba projects went into shock. The moral commitment trap closed when the gap between promise and reality could not be bridged. Toshiba could not simply abandon the projects without triggering contractual liabilities, completion guarantees, and regulatory complications in the United States. In March 2017, Westinghouse filed for Chapter 11 bankruptcy protection. Toshiba then disclosed a roughly $6 billion hole linked to the nuclear overruns. That formal recognition eliminated plausible internal fixes. Creditors and regulators demanded action. Toshiba moved to raise cash by divesting assets. The company sold major holdings and prepared to part with businesses that had once defined it. The decisive consequence was the sale of Toshiba's memory chip division. The unit had been the company's most profitable engine. Selling it stabilized the balance sheet. It also altered the company's identity. The human impact was immediate and personal. Longtime employees watched factories switch to new owners. Engineers who had spent careers building Toshiba memory technology lost institutional control of the work they had created. Shareholders saw market value evaporate. Executives who championed the nuclear era resigned or were replaced. Local communities that relied on Toshiba jobs faced uncertain futures. Pension funds and regional suppliers confronted a new reality that none had planned for when Toshiba declared a bright nuclear future. The collapse did not begin in isolation. Toshiba's corporate governance had shown weakness earlier. A 2015 accounting scandal that overstated profits, forced management changes, and weakened trust in board oversight. That prior failure mattered. It reduced internal checks and left a governance structure less able to catch, escalate, or stop a single high-risk strategic bet. The nuclear commitment landed on a company already compromised in oversight and transparency. Escalation continued after the sale. Legal probes and regulatory scrutiny followed the write-downs and the bankruptcy of Westinghouse. Buyers and creditors recalculated long-term industrial partnerships. Japan's corporate governance debates intensified as regulators, investors, and business leaders examined how a landmark company had let a single strategic wager metastasize into an existential crisis. The forensic chain is clear. A 2006 acquisition transformed Westinghouse's obligations into Toshiba obligations. Fixed-price construction commitments removed the option to walk away. Engineering complexity and regulatory delay increased costs. Early warning signs were not matched by decisive corrective action. Weak corporate governance and an earlier accounting scandal reduced internal resistance to escalating commitments. The cumulative result was a roughly $6 billion collapse tied to nuclear projects and the forced sale of the firm's most valuable business. Stay with this story. The loss rippled across an industry. A generation of semiconductor know-how passed from a Japanese industrial icon into a consortium reshaped by foreign capital. U.S. nuclear projects stalled, renegotiated, or changed hands. Credit markets priced the risk of supplier guarantees differently. Policymakers in Tokyo debated whether corporate culture had prioritized pride over prudence. Investors demanded stronger boards. Engineers and plant workers adjusted to new owners and new rules. The moral cost is as stark as the financial one. The commitments Toshiba made in the name of national pride and technological leadership created obligations that could not be reversed without catastrophic cost. A gamble meant to secure the company's future consumed the company's most valuable present. The balance sheet was not the only casualty. Trust between workers, managers, and communities fractured. The memory of an industrial champion was permanently altered. The final lesson is not subtle. Large fixed commitments in complex projects transfer risk in ways that can overwhelm even diversified firms. Acquisitions that bring guaranteed obligations require relentless, independent scrutiny. Strong governance matters before and during a crisis, not after. When corporate faith in a single strategy replaces sober risk control, the consequences can be irreversible. Learn the warning signs.